Well, thank you all very much for joining us this evening. We hope you get a lot out of tonight. We've got some fantastic speakers lined up. But yeah, certainly thank you all very much for joining us. It's been an eventful 48 hours, and I'm sure the next 24 to 48 are going to be equally as eventful, and maybe even the next few days and weeks, given how this election may pan out. But obviously tonight we're going to be covering an array of topics around the US election, what it means for markets, what it means for investors, where are the opportunities, where should we be positioning our portfolios, where are the opportunities going to lie, and most importantly, when is the time to strike? So hopefully with Samir and Will, who I'll introduce shortly, our speakers this evening, we'll be able to actually have an in-depth look at some of those key questions. But before I introduce Samir and Will, a little bit about Global Financial Consultants, why we're here this evening. So Global Financial Consultants is a financial advisory firm based in Singapore, originally started, which I'm very proud of, being an Australian, back in Australia back in 1997, so 23 odd years ago, moved to Singapore in 2003 and is now the longest standing non-institutionally owned or aligned advisory firm in Singapore, and certainly one of very few in Asia. So something we're incredibly proud of. We have a very highly skilled, adept and diverse team of advisors and work with clients all over the world now. So covering everything from insurance to investments to pension planning to retirement planning to savings to working out what on earth do you do with your investments when there's a US election taking place. So some of that we're going to dive into this evening. A little bit of housekeeping, as I touched on earlier, we have both the Q&A and the chat box going. If you have any questions, if you think of anything as we're going through, please feel free to pop in either. We are monitoring both. We will make sure we get to all questions. This evening, we'll be sending out a recording as well of this evening's webinar, but we will make sure that all questions get answered. We'll get to some questions probably throughout the presentations. Some of them we may keep to the end. So just bear with us on that front. Yeah, there will certainly be plenty of time for questions. But on to the US election. So we are probably still a little way off a clear answer. For anyone who's been following the results, Biden looks like he's in front. The Senate looks split. So I guess as may come as no surprise to many, we have no clarity on exactly what's going to happen next. A couple of things are for sure though. We will have the oldest leader of the United States ever, whether they are 74 or 77 is irrelevant. Either way, they will be the oldest leader of the United States. It will also be the most expensive US election on record at $14 billion. If the US election was an industry, it would probably be a very good investment. Record amounts of money get spent, obviously with Trump's earlier commentary around removing post office boxes and removing the ability for people to actually submit postal votes meant that Biden got onto the phones early. And I guess as someone who is 77, one of the ways of marketing that he understands well is calling. So you get on the phone and you try and rally the votes, and that's exactly what's happened. So we're seeing some interesting headlines come out. Someone from the US Postal Service is already acting as a bit of a whistleblower, saying there might have been some false dates put on certain envelopes. It's going to be a mess. The lawyers will get wealthy, and hopefully in a week or two's time, we'll have some answers. But other than some interesting trivia, I will hand over to our speakers who will share far more detailed insights tonight. So with us, we have two fantastic speakers, and it's an absolute pleasure to have them both join us tonight. We have Samir of Bluefire, and I'll tell you a little bit about Bluefire. Samir is highly intelligent, originally started as a macro economist with the Monetary Authority of Singapore, then is the co-founder of Bluefire AI, which is a capital markets intelligence firm. So risk status, risk data when it comes to both equities and fixed income investments. So Samir is going to share with us his views on the election, on markets, on where he sees things heading. Now I'll introduce Will a little bit later as we head into Will's presentation. But Samir, I'll hand over to you and you can walk us through where we should be putting our money.
Thank you, Jared. Can you hear me loud and clear? All good? Perfect. Give me a thumbs up if the slides are good. Perfect. Hi, everyone. Thank you so much for joining us this evening. And really, the matter on the top of our minds of a lot of us is America's voted. It was probably one of the most anticipated events of this century, with a lot of uncertainty, and we still are none the wiser for how this is really going to play out in the near term. Most of you have probably seen some version of this with any interest in the elections. At the surface, it looks like Biden's pretty close to a win, really needs 6 more. Nevada's most likely going his way. But when you go below the surface, there's a fair amount of states where the margin of the win is small enough that it can create some frictions and challenges in us identifying who's going to be the next president of the United States. Just as a little bit of a background, this is what the actual election timeline looks like. So we're past November 3, which was election day. And then a bunch of states have different levels of counting procedures. Places like Pennsylvania cannot start counting before election day, even for mail-in ballots and stuff like that. And the idea is that all the states have 5 weeks to count ballots and settle any disputes. On December 14th is when state electors cast their ballots, and the winner must secure 270 votes. Everything goes well, we should very clearly know what happens by December 14th. Now, the issue here is if you look at the playbook that the Trump campaign has been following, on Wednesday, Trump falsely claimed victory ahead of time, if you might, and he started demanding the halt in counting of mail-in votes, claiming that such counts are really fraud and not very democratic. To refresh our memories, a couple of decades ago, how thin the margins can be, Bush won against Al Gore with 537 votes after the High Court of Florida halted a recount. It didn't even finish because you can't halt a count, but you can halt a recount. And Trump is obviously already lobbying for halting the count. He has indeed arranged a pretty massive array of lawyers whose qualifications look quite daunting. At the same time, he has appointed Amy Barrett, creating a 6-3 conservative majority. If things were to go to Supreme Court, which would be a pretty sad day for almost all of humanity, the world's second largest democracy, deciding its elected candidate using a judicial mechanism, that could favor him. More importantly, that December 14th date is quite important. Governors usually give the summary of how the popular vote has gone. At the same time, the Electoral College also votes, or the electors, if you might. If there is a conflict between the two, the vice president has the ability to cancel the state out. This has never, ever been tested in the entire history of the United States. No one really knows how is it going to work. A second thing that people don't know anything about is what happens if 4 or 5 states get canceled, or let's say 3 states get canceled because the margins are so small and there's a conflict, and no one really gets 270. Is it a simple majority of the remaining votes that are eligible? We don't have precedent. So Trump does have certain elements that could create a fair amount of chaos and confusion. And then finally, there's a contingent election under the 12th Amendment that could happen. Again, completely untested. So the next couple of weeks are going to be relatively interesting. Now, before we jump into a more forward-looking view, I would just like to summarize here, and the source is BlackRock Institute. They do very thorough work. If anyone's interested, I would suggest staying abreast their thought process, where they created 3 scenarios for if Biden wins with a full Democratic control. Doesn't look like that's going to be the scenario. Would have been quite positive for fiscal stimulus and public investment. If Trump won with a divided government, there would be some fiscal stimulus benefits, but largely nothing would change from how we are today. Now, what looks like the most likely outcome, Biden's probably going to win with a divided government, which will be great for foreign and trade policy, as well as international relations, which most of us probably have seen deteriorate over the last 12 to 15 months becoming bilateral rather than multilateral between different nations. It's really a US and China duke out going on at the moment. But other than that, it would be slightly negative for most other aspects, with the Republicans blocking majority of the Dems' plans. Whatever happens, one thing is for sure. The China and US duke out is going nowhere. It's only getting worse. Whether you look at Republican opinions or Democratic opinions in the US, at this moment, most Americans have a very unfavorable opinion of China. There's something just to keep an eye on as you think around your investments and strategies. That said, if we go back and look at the history of US elections, and we're going back all the way to 1945, yeah? Equities have historically performed well, regardless of which political party comes back in control of the House. And, I'm guessing, Jared, you'll be sending the slides out. So for people who are more interested, you can see which party the president belonged to and the Senate and the House, where it was. What you will notice is the two very performant years is if both houses, at least two out of three get controlled by a party, the returns are really phenomenal. Another thing, a lot of people have been talking about the capital gains tax in the United States being changed. These are all the times in history capital gains tax rate was changed. So whether it was decreased or increased didn't really have a meaningful impact on the equity market. So it's more of really a talking point versus how assets will perform once we get down to that. Now, where are we with the virus? That's the other large factor that decides our investment strategy if we look forward into the future. You're probably well aware that hospitalizations in the US are skyrocketing at a really fast rate. The deaths have not yet picked up. However, ICU admissions have really picked up. So over the next couple of weeks, we might see certain negative developments on the virus front. When we think about how much the economy has been affected, and this is quite important to put things in perspective, the recession in 2001, when the tech bubble burst, it put the economy back by 6 months. When we had the GFC, it put it back by 3.5 years. As we look at where we are right now, that's back by 5.5 years. So this has been a really massive hit, very sharp over a short time frame. In the global financial crisis, that hit happened over 18 months. We've had this hit over barely 6 to 7 months. However, the recovery also seems to be properly on its way. So when you start looking at higher frequency indicators of activity, like total credit over debit card spending, or US freight, carloads, or all sorts of mobility measures like driving, transit, walking, the US seems to be coming out at an activity level really strongly. We don't yet know what the spending patterns exactly look like. Those will show up in the coming months for the latest quarters, but the high frequency activity pieces look reasonably good. There are certain market dualisms that exist at the moment that one needs to stay aware of. These are not normal situations. The first one, the coronavirus cases are rising, but the economy is making forward progress. There's a little bit of a lack of tight linkage between these two pieces. One thing that has been quite heartening is increased consumption has not led to savings drawdowns in the US. That's a good piece. On the other side, while inflation is picking up, the Fed will probably keep its monetary policy still quite loose. It will look to tolerate higher inflation compared to its previous rhetoric in any other time, which has been a non-pandemic led situation in the economy. Historically, whenever we go into an earnings recession, where a majority of the listed companies in the US, especially index constituents of S&P 500, get into an earnings recession, they take roughly about 3 years to bounce back. So this is what we would expect from the, when we look at analyst estimates from all the top investment banks, it's really in 2021 that they start crossing the levels they had set in 2019. And 2022 is probably going to be a really good year. Generally, equity markets start responding almost 9 months before that. However, the situation in credit might not be that rosy. We're seeing a lot of downgrades in the credit markets, especially if you're exposed to high yield credit. Investment grade credit still holding up relatively well. High yield credit is quite dependent on the programs, the loan programs from the Federal Reserve. If those programs dry up, we could see some significant stress in the credit markets. What about the rest of the world? These are the latest estimates from the IMF. It's a little bit disparate between various countries. What you'll notice is China and emerging Asia is actually well on its way and doing relatively well. And expectations for a 2021 rebound are reasonably strong across majority of countries, i.e. the economies have started adapting and they're starting to respond so that they can at least come back to some sort of a baseline scenario. When we look at financial conditions have dramatically improved, and this was largely because of the quick and decisive intervention from majority of central banks as well as governments through fiscal interventions in countries like Germany and Italy that has kept the financial conditions from tightening less than it did during the GFC. So we're seeing a very unique situation where the financial markets are actually kind of fine, but the real economy is at a much worse situation, but steadily improving. Now, as we also think about investments, one piece which might get lost in this entire messaging, and this again ties back to the original point about the US and China going at each other, the Chinese middle class is really starting to flex its muscles. And it's really starting to drive a lot of the incremental demand that we see globally across all countries. And it's right now the largest middle class consumer across the entire world. Of course, total consumption in the US is much higher, but the middle class consumption and hence the kind of goods and services that are being demanded, the Chinese middle class is really driving that. This reflects itself. And when you look at the overall emerging markets index, China dominates the contribution into the moves in the overall emerging markets index, with countries like Brazil, South Africa, India, Russia, and Indonesia not having done very well over there. Few things to keep in mind before you create your investment strategies. There are some permanent winners and losers. This is not coming back or reversing. We are fundamentally changing how the future looks. Technology is definitely a permanent winner, while traditional retail that depends on footfalls is a permanent loser. Large companies will weather this storm much better than smaller companies. So previous strategies like buying small caps and getting a small cap premium is not going to work that well anymore. Large companies have access to more cash lines and they will perform far better. Developed nations with more economic and natural resources will fare a lot better than less developed countries. Millions of SMEs will fail. This is a piece that is not being recognized when you look at overall traded market asset prices, whether it is stocks or bonds, and that's going to hit the incremental demand for these companies finally. Now, if you were to decompose the S&P returns for the year, which don't look really bad, if you just look at the top 5 tech companies, they're up about 42%. If you strip that out and you look at traditional high dividend stocks, which form the portfolios for a large number of IRAs and pension funds and insurance companies, they're actually down by almost 20% over the year. The world stock markets also reflect this. There is a big divergence and very different valuations in equities of resilient firms and those in significantly impacted industries. However, I would like to end today's conversation with one brief reminder. In a long term, when we look back at the last 70 years, no matter what happens, it always pays to stay invested. When we look at this analysis, what does this really tell us? It tells us if we invest our money with a horizon of about just 12 months, we could end up anywhere between making 47% to losing 39%. But if we are investing over a perspective of, let's say, 5 years rolling, you're making 28% and barely standing the risk of losing roughly about 3% if you focus just on the equities. If you have a more balanced portfolio, you're probably ending up doing a lot better. And over longer term timeframes, it's quite hard almost to lose money if you stay invested in the markets. So it's a question of more not whether you should invest or not. Answering your statement earlier, Jared, is more a question of where do you invest? Where do you find good quality, both on the equity side of the house as well as the credit side of the house? And how do you allocate your capital that reflects your risk aptitude? You need to stay invested. And in the longer run, that pays out really well. I'll stop here and we can probably take some questions. Jared, do you want to do questions now? Questions later?
Beautiful, Samir. We might leave questions to the end.
Okay.
Yeah, and I'll throw anything at you if it arises that's particularly urgent. Otherwise, we'll keep the few that we've got there until the end, if you're happy with that. But no, look, I think you've raised some really excellent points there. One, certainly, I mean, staying invested, not trying to time the market, as every market correction has shown us in the past, trying to time exactly when to get back in, it's a bit of a fool's game. And if the experts can't do it, well, how on earth can the average Joe? And I think that's sort of largely amplified, and certainly as a bit of an example, if we just look at the media, typically on average, we're going to miss about 15 to 20% of the bounce before the media starts suggesting that it's safe to get back in. The average journalist that I know is not terribly wealthy, so perhaps we actually need to get our investment research from somewhere else. So yeah, certainly staying invested. But I think you also raise a really very important point there, though, Samir, in terms of there are going to be some serious permanent changes from this. This is not a blip that's going to disappear, whether it's tech or it's cybersecurity or it's esports. We're seeing some explosive growth in India around girls in esports. The numbers are phenomenal. There are going to be some sectors, industries, countries that will be changed forever. So I think it's a wonderful time, if you're not already invested, to start looking at investments. But if you haven't looked at your portfolio for a while, certainly a very good time to start talking to your advisor and as you say, start looking at both your equities and bonds and work out where the risks lie and where the opportunities do also. So no, really appreciate it. Thank you, Samir. So we'll hand over to yourself. Now, Will Price joins us from Quilter International. Will's been in the international insurance structuring, high net worth investment space for many, many years. I believe around 18 years, if I'm not mistaken, Will.
Yeah, I'm in my third decade now, unfortunately.
There you go. So, so Will's been with Quilter for a number of years now, since 2014, was previously with Zurich, one of the leading expat international insurance firms. So certainly knows the space of structuring assets, tax minimization, estate planning, that whole space very, very well across a wide range of nationalities. So we're delighted to have Will join us. We've heard a little bit about the markets, how you should be positioning your investments, what to look out for, where the opportunities might lie. So now we're going to take a bit of a swing and start looking at what you might want to think about when it comes to actually structuring your investments. So Will, I'll hand over to you and you can walk us through what we need to be thinking about.
Okay, all right. Thank you, Jared. Just sharing the screen, is that all okay? Yeah, cool, thank you. Okay, so thank you, Jared, and thank you, Samir. As Jared said, we at Quilter specialise in structuring clients' assets to help them achieve their long-term investment goals. We provide a series of platforms for clients to invest into. But before I get into the detail of exactly how that works, I'll give you a little bit of background on the company itself. Quilter PLC, formerly known as Old Mutual Wealth Management in the UK and part of Old Mutual PLC. We separated from Old Mutual back in 2018 and became Quilter PLC. And we are one of the largest wealth management businesses in the UK. We are listed, as it says there, on the London and Johannesburg stock exchanges. We're a FTSE 250 organisation, and we manage in excess of 110 billion sterling of clients' investments, have over 900,000 customers, and as you can see, there's our A rating from Fitch. So whilst we're not the largest name in Singapore, our office is a relatively small sort of sales office of just 13 people. We do employ many thousands of people globally, and as I said, we're one of the largest wealth management businesses in the UK and in our chosen international markets. On the international market side of things, that's what Quilter International, which is the part of the business that I work for, that's what Quilter International specializes in. Our main focus is looking after the finances of clients that are living in different countries or have assets in different countries. It can get very complex when you're trying to determine what's the best options for you when you have those multi-jurisdictional areas at play. So Quilter International, formerly of Mutual International, changed our name earlier this year, and we are probably the leading cross-border provider of these types of solutions. We are headquartered in the Isle of Man, and we've been there for over 35 years now, and we serve customers all over the world. We have an office here in Singapore, obviously, but also in Hong Kong, Dubai, Europe, Latin America, and so on. So why is an insurance person talking to you about investments? Was probably the first thing that pops to mind. And why would someone consider using an offshore insurance bond as a way of holding those investments? What can an offshore insurance bond do for you? You can hold a very wide breadth of assets, and we have something in the region of 37,000 assets approved for use on the platform. And we add to that constantly. It's possible for clients to transfer in existing assets, which ties in very, very nicely with something that Samir was talking about making sure that you remain invested in the market. There's no need to sort of sell any positions you have elsewhere and then move cash over to a portfolio like ours. You can simply transfer an existing asset over without any charges. You also can benefit from our discounted terms. We're obviously a large institutional investor, and we get good discounted terms from various different fund houses that we can help pass on those savings to you as clients. And we have a full online service, which is obviously essential in this day and age. So if I just move on to the different sort of styles of ownership and why an insurance platform might be of interest to a client as opposed to the perhaps more traditional methods of ownership. Typically what we might see from a client who hasn't yet had financial advice, isn't working with the likes of GFC, is that they would have various different assets, private shares, unit trusts, ETFs, etc. And they hold those in a slightly haphazard manner, which makes it quite hard from an administrative perspective for them to manage. It's difficult for clients to necessarily know exactly how much they have invested, what it's worth from day to day. If they want to sell down their positions, they have to work with lots of different institutions, provide the endless copies of passports and proof of address documents to lots of different institutions. So one of the things that many advisors will consider for their clients is moving and consolidating those assets into some form of trading platform. Here in Singapore and many countries around the world, there are obviously lots of different options available. You have, working with banks, you can work with trading platforms direct, such as your iFasts of this world. And they do provide some good administrative benefits. But one thing that doesn't change is the nature of the ownership of those assets. Whilst you hold your shares, ETFs, unit trusts, etc., within a trading platform, you're still the registered owner of that asset, which can work against you sometimes when it comes to tax planning opportunities, which is one area that we specialize in. So next step on from that is to look at holding those same assets within an insurance wrapper or insurance bond, as they're also known. And what that does is it separates the client from the ownership of those direct assets. So you change the nature of what you own as a client. You you now own an insurance policy, the value of which is directly linked to the value of the underlying assets. But those assets are now actually registered in the insurance company's name. So if I take an example of some, say, Facebook shares, you can transfer those over. And when you transfer them into a trading platform, they're still registered in your name. But if you transfer them over to an insurance wrapper, Quilter International in this circumstance would become the owner of that asset. You now become the owner of an insurance policy. So, why might that be of interest to clients? What advantage does that hold? And on the sort of taxation side of things, one major benefit, given the topic we're discussing today in the US elections and how large, well-established companies, as Samir was saying, are a good option going forward by the sounds of things. You might want to hold Facebook, Apple, Microsoft, and various other tech stocks as just one example, or you may already hold them. If you hold them outside of a insurance policy, you could run into some issues when it comes to US estate tax. I think many people don't necessarily realize that any US situs assets that they hold are liable to US estate tax on death of that owner. So this would include things like mutual funds, shares, property, and so on. And the personal allowance, as you can see there, for a non-US citizen is only $60,000 US. So it's not a very generous allowance. If you own any more than $60,000 US of US assets, such as Facebook shares, then on death, holding that asset, you would be taxed between 18 and 40%, depending on exactly how much you own, which is a very significant number when you've ideally been intending to leave that wealth on to your loved ones. US citizens are, well, they're generally not very fortunate when it comes to tax because they get taxed wherever they live and quite a large amount of money. But in this one instance, they get a much more generous allowance. So currently something in the region of 11.4 million US dollars. So it's only if their estate is worth more than that they have an issue. But for non-US citizens, which probably covers most of us in this particular webinar, your allowance is just 60,000. Anything above that, a significant tax bill to pay. So how can we help with that particular issue? As I mentioned, moving those same assets into an insurance policy changes the ownership of that asset. So if you were to die owning an insurance policy with Facebook shares in it, it's not the owner of the Facebook shares that's died, because the owner of the Facebook shares in this instance is Quilter International. So there is no estate tax liability arising in that particular scenario. And as I said, we don't charge for the transfer of those assets. So it's a very simple solution to remove that liability. Everybody who owns shares, they've got to hold them on some sort of platform. Why not use a platform that also removes that US estate tax liability that they potentially have? And sort of key things to consider here is not just the individual investor who has chosen to invest into various different US firms, but it could be people that are working for one of the US companies. There are many US companies who have significant presence here. Obviously, Facebook have large offices, Microsoft, lots of the banks, your JP Morgans and so on. They all have a large presence here in Singapore. And as part of the package that you may have, if you work for one of those, you'll probably be receiving some shares as part of your bonus package. Once those vest, you're now the owner of those shares. Why not move them over to a platform which can help you with that US estate tax liability? And then the second main area I'm going to touch on with regards to tax, there are many others that I can cover on a separate session as required, but the concept here is what we call gross roll-up, and that's where you get tax-free investment growth depending on the jurisdiction you live in. For many of us working here in Singapore, but who are from higher tax jurisdictions, we're very fortunate in that the tax regime here in Singapore is relatively low. They don't tax foreign investment income, so our investments can grow free of tax whilst we live here in Singapore. But should we return to our native countries, the UK in my case, Australia in Jared's, those same investments, if we hold them in an unwrapped platform, every time we decide to rebalance a portfolio, sell a particular asset, buy something else, any gain that's realized would be liable to capital gains tax. And looking at countries like the UK, India, Australia, those tax rates can be quite significant, and that can create quite a large drag on the performance of your policy. So again, because of the nature of the change of ownership, the fact that when you transfer your assets, whether that be US citus or other assets, when you transfer them into a insurance wrapper, every time you decide to sell an asset, it's actually Quilter International, based in the Isle of Man, which doesn't have any capital gains tax, same as in Singapore, that's actually selling that asset. So you don't have any tax at that point in time. And that means that there's much greater potential for the value of your investment to grow, because you're not getting that constant drip of tax coming out every time you realize a gain. And as it says, there's no limitations on the amount that you can invest with us. So just to run through one quick case study on this, just to finish up. We have, in this example, a lady called Rachel who has an offshore bond. She is a 40-year-old Australian expatriate, but obviously could be from anywhere around the world, in Singapore on a short-term work contract, and utilizing the fact that we live in a relatively low tax regime to try and save significant wealth for the future. Currently, in this example, has 720,000 to invest, and we'll look at adding to that as annual bonuses come through. By moving those existing assets into an offshore bond, an insurance bond, she has a vehicle that's portable. So if she returns back to Australia or moves on to Hong Kong or Dubai or wherever it might be, that investment platform can move with her. It provides lots of flexibility, and those investments can grow in a tax efficient environment. The sort of common scenario we use to keep the math simple for me is that if somebody was to achieve 7% growth on their investment on a 10-year period, then your investment doubles in value. So in this example, that 720,000 becomes 1.4 million. If you were to sell that and pay as 20% tax as you would if you're a UK resident every time you realize that gain, that's going to be a significant drag on your portfolio. So it's very important, just to summarize, to consider not only what you invest into, but how you hold those investments, whether you hold them via a bank, a trading platform, or in this scenario, an insurance policy, which can help shield you from some unexpected or unwanted taxes. So that was it for my presentation. Obviously, welcome to answer any questions that people have.
Wonderful. Thank you very much, Will. We've got a myriad of questions there. I think you've raised some excellent points there. It's all well and good to know where to invest, what to invest in, what stocks, what bonds, what sectors, what currencies, but getting the structuring right is just so critically important, particularly as an Australian expat. I mean, it's certainly one of not the only motivation to remain in Singapore, but when I compare almost a 50% tax rate to a 15% tax rate, give or take, it's certainly very appealing to remain in Singapore, and particularly with no capital gains tax and all of the various options, like the quilters and the insurance bond structures that we have access to. It's just a whole different landscape. So no, certainly appreciate it. So guys, we have a raft of questions, so we'll dive in. We've got a few to get through, a few for each of you actually, which will be good. So let's tackle the first one first. So Samir, you touched on China, emerging markets as being potentially a a good place to be looking. You talked about the growth of the Chinese consumer in terms of their spend. So this question relates specifically to currency movement. So what happens to those investments in China, in those emerging markets, if the US dollar were to strengthen? And maybe if we could just tack onto that as well, what happens if it goes the other way? You know, what happens if the US dollar weakens?
Yeah, thanks, Jared. I think maybe the messaging got a little bit missed while I was talking through this. So what I was really trying to make a point is when we look at the emerging markets performance and we look at any emerging market ETF's performance, we're really only looking at Chinese performance. None of the other emerging markets right now are in a position which looks very promising. Majority of the emerging markets have very weak central banks, not relatively strong fiscal balance sheets. They can't have loose monetary or fiscal policies. They really can't help their companies, even if they want to, within this stress scenario. So if you're heavily invested in emerging markets, you might want to reposition that a lot more towards just purely China or Chinese plays like Vietnam, you know, which is really a Chinese play as you walk through that. So I hope that clarifies that point. It's not emerging markets and China, it's only China. The rest of the emerging markets right now is not in a very good place. When we think about the US dollars, so the US dollar, you know, it really depends on what's your base currency of your investments, as most of your portfolio managers and your advisors will advise you. But it's really at the end of the day, what kind of risk do you want to take? If you don't want any currency risk, you've got a significant chunk of Chinese companies that are listed in the US, and you gear yourself towards exposing more of your wealth towards those companies. So you just get rid of the FX risk from your portfolio. You can buy ETFs focused on that. You can buy mutual funds that primarily own just ADRs of Chinese companies listed in the US. However, if you've got a view that over the next 10 years or 5 years, if you're talking longer term, the Chinese renminbi is most likely going to appreciate against the US dollar, you might prefer to hold, you know, Alibaba shares in Hong Kong rather than have Alibaba shares in New York. So from that perspective, it's first, what currency do you really care about? And then second, what is your risk appetite? If your risk appetite is not very high, my suggestion would be to stay with Chinese companies listed in New York. If your risk appetite is high enough, because you've got a lot of really powerful Chinese companies listed onshore that you can now start accessing through stock connects and stuff like that, or even Chinese mutual funds or you know, Chinese bonds. There's a fair amount of products coming out. I don't know if you've seen Matthews. It's a product manufacturer. By the way, just full disclaimer, nothing to do with any product manufacturers, but just generally their performance on onshore Chinese companies, which do not have dual listings in any other jurisdiction. They've done a relatively good job at picking companies up quite early in their journey. So if your risk appetite is higher, take renminbi-based exposures. I hope that helps, Jared.
That's perfect, Samir. Thank you. No, that's wonderful. Will, we might throw this one over to yourself. So a little bit of a broad case study. Singaporean permanent resident residing in Singapore has, in this particular example, but I mean, the number is probably not as important specifically, but I'll use the number $600,000 worth of US stock. So $600 US. If I pass away tomorrow, do I get hit with inheritance tax? Or estate tax, sorry, or any other tax?
Yeah, the simple answer is yes. But to expand on that, as I mentioned, if you hold that via an unwrapped platform, via your bank or a trading platform, then yes, you own those shares. When you die, there is a US estate tax liability. One thing I didn't touch on, but I'll briefly cover, is many clients understandably ask the question of, well, how will the IRS know when me as an investor in Singapore dies? Which is a legitimate question. But the thing that's really changed since the global financial crisis is that with government's balance sheets in a perilous position, they're very keen to increase the tax take. And a simple way of doing that is to make sure that people who should be paying tax do. So the US started off by bringing in something called FATCA, the Foreign Account Tax Compliance Act, which means that all financial institutions that are dealing with US dollars have to report data through to the US authorities. On the back of that, something called the Automatic Exchange of Information, or Common Reporting Standards, came in, and almost every country that you would consider investing into, there's over 115 or more countries that are now signed up to it, are reporting that same data. So when you die, your accounts get closed, that information starts flowing around, and it comes down to how good the analytical systems of the IRS are to start mining that data and going after people. And given the way the balance sheets are struggling because of first the global financial crisis and now COVID, they're very keen to get the tax that's due to them.
I think that makes a world of sense. So I guess in short there, the key takeaway is if you have more than 60,000 US dollars worth of US assets, start seeking some advice, and maybe even less, I guess, if you think it's going to go in above and beyond.
Yeah, absolutely.
Okay, thank you, Will. Samir, I'll throw back to yourself. I was going to say a simple one, no, a short question, but also a broad question. What is your view on the Aussie dollar? Are we going to see outperformance, underperformance relative to the Sing? Where do you think we're going to head?
Thanks, Jared. It's a bit harder to explain relative to the Singaporean dollar. I'll answer, sorry, I just don't pay enough attention to the Singapore dollar, so I'm not going to claim I know better. But compared to the US dollar and the renminbi, most likely the Aussie dollar is going to perform relatively well compared to the US dollars from where it is at the moment over the next 3 to 5 year time frame. It will, in my opinion, it will underperform the renminbi over the next 3 to 5 years, if you might. So depending on where you invested and what matters, where your assets and your investment income is and where your expenditures are, it might be worthwhile. If you've got a lot of American assets, so it might be worth hedging your Aussie dollar risk as you convert it back to Aussie dollars to spend in Australia.
Yeah, perfect. No, I think you raise a very good point there. It's all dependent on what you're planning to spend the money in and what your base currency is. It's all well and good to say what is the currency going to do, but if it's not going to perform the way you want relative to your currency, it really is a little bit irrelevant. So no, I appreciate that, Samir. Will, I'll throw back to yourself on this one. So British expat based in Singapore, again, a bit of a case study, a bit of a scenario here. British expat in Singapore, planning to return to the UK in 2 years. Let's hope the UK is more open and vibrant by then, or as vibrant as the UK can be. Would you still consider an insurance bond as a sensible structure? Now, this is a very broad question and a tough one to answer, I guess, without knowing, anything around their specifics. But I guess specifically looking at time frame, if you've only got 2 years, do you think an insurance bond is a sensible structure to consider?
It's certainly something to consider. There is a raft of legislation in the UK, and there is in many countries around the world, for these types of products. They are quite popular in the UK, so there's very specific legislation from HMRC as to how they're treated. And there are a series of reliefs, which I won't go into now because I could spend 2 hours talking about that alone. But there's a series of reliefs that are designed to help clients that have these types of products. The idea being that they may have bought something overseas, paid their taxes in that environment, Singapore, for example, and then they move back home, and the government wants to encourage saving and doesn't want to penalize people or tax them twice on money that's already been taxed overseas, and gives a variety of relief. So they are very popular, particularly for use as sort of retirement planning. People may accrue investments over time, move back to the UK, and they're able to access that in a tax efficient manner. And going back to the gross roll-up example I gave as well, that would be key in the UK. Capital gains tax in the UK is either 10 or 20%, 20% for a higher rate taxpayer. So you would pay 20% every time you sold an asset as a UK resident on any growth, and holding those same assets via an insurance wrapper would help to defer that liability and give you control as to when assets are taken, and therefore control over how much, if any, tax is payable.
Perfect. That makes a lot of sense. Okay, Samir, we've got another one for you. Now, this is an interesting one, and hopefully one you'll appreciate, because there's some data I think you can probably shed some light on here. So the commentary, I'll just sort of summarize the question here. China's GDP growth rate over the last 10 years has declined in percentage terms. Now, in nominal terms, I'm sure you can shed some light on what those real numbers look like. But the question then looks at, well, is this decline concerning when it comes to Chinese investments? Do you think we should still be looking at tech companies in China as a sensible place to invest, or should we be looking at markets like Vietnam, India, or I guess elsewhere in Asia?
That's a really, really fantastic question. So there are two elements to this. The first one is whenever we look at GDP growth rates, we have to constantly take into consideration the size of the economy. So when you think about the size of China, no country in our entire history, even if we scaled everything back to this kind of, with inflation and got it to real prices, at that size has ever grown that fast. It's beaten all records we know for the last 250 years. So there's a natural balance between size of a country and how fast can the country grow. So from that perspective, as China's growth is slowing, it is something that is quite expected. In fact, China outpaced expectations of growth with some relatively what maybe European and North American economists and policymakers would consider extractive policies or artificial policies. They're just coming back to the mean right now. This is more a natural state for where the Chinese economy should be growing. Then the second question, which is a little bit separate from when we think about Chinese companies, how do we think about them? There's a whole element of a lot of the Chinese companies' equity price growth or bond price growth has been based on domestic economies. You are right now, if you live here in Singapore, you're starting to see a new wave that is going to last probably 5 to 10 years again in the near term, where Chinese companies are getting ready for a global battleground, i.e. they're using Singapore as a training ground to prep. How do they aggress into other markets? If you look at most Chinese companies, their international revenues are quite tiny, with exceptions of people like Alibaba. Generally, most of them have made their money in China. The next wave of these companies growing up, this is exactly what happened with Japan in the 80s. So while the Japanese economy started slowing down, China is not going to slow down as much as Japan did in mid-90s and early 2000s. But Japanese companies kept growing really fast because they suddenly they'd grown in a large economy, fast-growing economy, and they were competitive enough to aggress into other incumbent markets. So you're seeing movement of global headquarters of companies like ByteDance, Tencent, all of that into Singapore as they prepare in a sparring ground, an equal playing ground, where they get as competitive as other companies. And they're going to be aggressing European and North American markets, which are very lucrative. Of course, we'll have policies to block, we'll have protective measures coming in. We're seeing all that play out with Huawei. The Canadians allege that Huawei actually stole intellectual property from Nortel, which was the original large telco in the early 2000s from Canada. So you're going to have a lot of this friction. But overall, if you look across the world today and you look at the megacorps, they're only going to get bigger and larger both Chinese, American, maybe some European companies as well. They're relatively safe bets over the next 5 to 10 years.
That makes a lot of sense. Thank you, Samir. Hopefully that that covers the question. I think it covered it off well. We'll throw back to you with another, again, simple, short, but broad question. How does the platform, and again, I think you've covered a bit of this in your presentation, but maybe if you could just address this one, how does a quilter portfolio, or how does a quilter insurance bond differ from something like Poems or ComSec in Australia, or Interactive Brokers, Saxo, a direct wrap platform? What's different about it?
Okay, so obviously the main thing, or one of the two key areas I've kind of covered in the presentation, that change of ownership. You now, instead of owning assets direct, you own an insurance policy. You have a contract of insurance. So you own a policy, the value of which is directly linked to the value of those underlying assets, and you can access that when you want. But because you change that ownership, it changes who is selling, and therefore the tax consequences of selling assets whenever you decide to realize gains or rebalance your portfolio. The other key area that I haven't touched upon is the fact that because it's an insurance policy, it's covered by insurance law, which means that you have the ability to manage transfer of wealth in a very efficient manner. There is something called a nomination of beneficiaries. So if I own a policy, I can nominate my wife as my beneficiary, and that means that when I die, those assets pass to her in an efficient manner. It's as quick as her filling in some paperwork and giving ID, proof of address, etc. So a week or two to receive those proceeds, as opposed to it having to go through probate. And with a complex estate, if you have assets in multiple jurisdictions, that can take months and months, if not years, to be resolved and for those assets to be passed on to your loved ones. So it's a really, really useful tool for that, managing that wealth transfer process when you ultimately pass on.
Perfect. Thank you, Will. I appreciate that. We'll throw another one to you, Will, while you're on a bit of a roll. Indian NRI based in Singapore, holding investments in Quilter, resident in Singapore. What happens when they return to India? How does the tax work? Do they need to pay tax in India? What happens?
So the whole gross roll-up story, as it were, is exactly the same. Obviously, different tax rates for India versus the UK or Australia, but they're still significant. But again, because of that change of ownership of the assets, when you want to rebalance your portfolio, it's not you doing that; it's Quilter International doing it. So you can remove some of that tax on the growth. Your investment can grow much more quickly because it hasn't got that drag. There are still taxes to pay. So if you want to sort of take money out of the policy, then it is taxable. But you are able to manage that process much more efficiently. Wonderful.
Appreciate that, Will. Now, before I just tackle the next questions, I'm mindful it is 7:02 by my watch. We are 2 minutes past. We do have a few other really great questions. So if everyone will bear with us, I'd love to just tackle these last few because I think they will really be helpful for everyone. But I do just want to raise that we are running a little bit over time, but I certainly think it'll be worthwhile. So bear with us and let's get into these next couple of questions. Another one for you, Will. US citizen based in Singapore. The wonderful case that we all love dealing with. How on earth do I reduce tax exposure in the US? Are there assets? Are there structures? What can I do?
It is the most difficult nationality to deal with and manage tax for. The US has the largest tax code in the world, followed by India and the UK in that order. So it's very complex, and they're unique. Well, they're almost unique in having a worldwide basis of taxation. So regardless of where you live, whether you live in the US or not, if you're a US citizen, you pay US tax. There is one other country, and I'd be very surprised if anyone knew which it was, that has the same basis for taxation, and that's Eritrea. Although China does have some similar aspects like that as well. But yeah, there are some solutions which follow a sort of pension trustee type arrangement that can work. They work off a double taxation agreement between the US and Malta, which can be favourable to US citizens. But yes, it isn't easy to plan for US citizens, but there are still some options out there.
Wonderful, thank you, Will. Samir, apologies, we've got 2 more questions. Samir, I'll throw one to you. Quite a specific one, energy. Where does the oil price go under either outcome? Do you think it's a good investment? Is oil going to remain soft? Where do you see that space heading, I guess, over the short, medium, and long term?
So I think there are 2 ways. Sorry for being ambiguous on this one again. There are 2 ways to tackle this. There's oil as a commodity by itself. Oil as a commodity by itself, as the global economy starts charging back, you're probably going to see significant pickup in the oil price quite early next year. So Q1, Q2, you should see that pickup. However, oil companies and energy companies, it's a fantastic time to start going long. There's a lot of really high quality companies that have gotten smashed through this year, and the valuations are off from the peaks. So if you can find companies which are strong with, the things you should be looking out for is strong cash flows and really low cost of capital. That's the important part, because a lot of these companies generally have a requirement for constant capital to continue their operations. So as long as the cost of capital has not spiked while oil cost has dropped, they are performing relatively well, and they're in a great position to pick up. And you can actually see some of these companies outperform the other energy companies. So if you've got the patience and you can spend some time, this is a good time to be picking up really decent energy companies that are going to give you a significant return over the next 1 to 2 years. It's not even a long-term horizon. A lot of them are mispriced because people don't have the time to spend on it.
Perfect, thank you, Samir. That's very helpful. And Will, final question for you. Again, a relatively simple one. UK expat, British expat, based here in Singapore, holding shares in the UK, so London listed. Would I get hit with estate tax, or inheritance tax, or any other taxes that I need to worry about with UK listed shares?
Yes, so there's 2 things to consider here. UK listed shares do have an estate tax, or the Brits call it inheritance tax, or even though it's actually more like an estate tax. They do attract that. The allowance is a bit higher, so rather than 60,000 for US estate tax, US dollars, it's £325,000. So you have a higher nil rate band, it's called. But anything above that, then that gets taxed at a flat 40%. So if you have a significant amount of UK shares, then there could be a tax liability. But it's very different in terms of how it's treated for a UK domicile, is the terminology, and a non-UK domicile. So if you look at people that are not from the UK in Singapore, it might have people working for UK companies like HSBC, Standard Chartered, Rolls-Royce obviously have a big factory out in Geelong. They might have shares in those companies. If they own more than £325,000 worth, on death, 40% tax bill. Same solution, change the ownership of the asset by moving it into an insurance wrapper, you remove that liability. For a UK domicile, it's a very different picture. So someone like myself, who's originally from the UK, my entire worldwide estate gets taxed at 40%. And it's much harder to manage that, but there are some opportunities, trust planning, using insurance to make sure there's liquidity to pay the bill. There are options there. Quite a complex area of advice, and that's something that obviously, as you know, I work very closely with GFC to support on that, because it's important that advice is there and that it's carefully planned.
Wonderful. I think that that answers it very clearly, and I do hope that was helpful. But please let us know if there wasn't anything quite covered there. It's we're a little over, but I think that's been fantastic. I've certainly got a lot out of tonight. Samir, Will, thank you both very much for your presentations tonight. I think we've covered a wide array of areas. We still don't, I guess, have a clear answer on who's going to win the election. And I've just seen there's a bit of an issue in Detroit now. Around 5,000 odd voters that registered have actually already passed away. One had a date of birth of 1838. So I think the next few weeks is going to be fun and games. But I think we've really got a lot out of tonight. We will be sending a recording out from this evening, obviously with the copy of the slides over the next couple of days. So early next week. If you don't receive it tomorrow, it should come through early next week. So certainly keep a lookout for that. But thank you all very much for joining us. As I said, we'll be sending out the email. So if you have more questions, if there's anything you want to ask one of our advisors, our team, or Samir or Will, on an individual basis, let us know. You'll have the contact details there as well. And also a special thank you to KitKat Marketing and Events. They've done a fantastic job in making tonight happen, making this webinar possible. So a bit of a shout out to them and their team. Thank you for all the work that's gone into it. But again, thank you all very much for joining us. I hope you've got a lot out of tonight. Stay safe for those in Singapore. Bring on phase 3. For those everywhere else, I hope you stay safe and well. And thank you all very much for joining us. Take care.